Welcome to vacationlord.com, your source for tools and tips for managing vacation rentals. In this video, we talk about how to file your tax return if you're renting a room in your personal home. So under this rental situation, you are renting a room that's in the home that you live in. It's not a home that is specifically set up either for short-term rentals or vacation rentals. Now, with the advent of sites like Airbnb, this is becoming easier and more common than ever, and it may be the situation that you're in right now today. Now, you may be wondering, well, I'm renting my home, I'm making money, how do I file this on my tax return? Or do I even need to file it? So we cover all those details, and by the end of this video, you'll have a very good understanding of what you need to do in order to file this on your tax return. Now, the very first thing you should know is that if you rent your room, or if you rent any property for that matter, for 14 days or less, you are not required to file a tax return. So that 2 weeks is something of a minimum where if you do more than 2 weeks and you do it consistently year over year, then it is expected that you should file the property on your tax return. So that's the very first thing. If you don't meet that 15-day threshold, then you don't actually have to file. Now, if you do meet that 15-day threshold, then you're going to need to go through all of the forms required to put it on your tax return. Now, we're going to cover what is the most common situation for people who rent rooms. And we're going to go through this at a detailed level, but here's the high-level summary. You're going to file what's called active participation status. This is actually the most common filing status for rentals, even in a situation where you're renting a complete home out. And simply put, what this means is you are renting as a side job. This is not your main business. Your business is not renting homes. Your business is something else. Maybe you have a day job. Maybe you have some other business that's unrelated to the rental. So that's the first criteria. And the second thing is we assume that you are at risk and that you own the property 100%. And what that means is you bought the property with your money, and your money is at risk, meaning you spent your own money and not someone else's money. And that's usually a fair assumption. Now, unlike rentals that are 100% rentals, as opposed to being a room rental, under this room rental situation, is it expected that you might have personal use for the property? And there are ways to specify that as we go along. So don't assume that just because you're renting it out that you can't personally use it. That's definitely not true. So these are all the assumptions that we're making here. So let's get started. For this video walkthrough, we're going to be using H&R Block tax software, specifically the deluxe version, which is more than capable for what we need to do in this walkthrough. So let's get started. And what we want to do is we want to go to the appropriate section to enter our rental activity, which is rentals and royalties. Now, if you were adding a new property here, you would click Add Activity, but I've already entered a property here that we'll walk through. It'll make it easier for me to do this walkthrough, but keep in mind that if you would actually click Add Activity when you're getting started. So I'm going to edit an existing property that I've already entered. Now, the first thing you want to do is enter the information about your property, the address. And again, we're assuming that you owned it throughout the year and that you own it 100% and no one else has any interest in it, which are fair assumptions for most people. And also, we're assuming it's a vacation or short-term rental, that it's not a long-term rental, which would be the case if you're renting a room, for example, on Airbnb. That might actually be the case. Now, to make this filing different from a normal rental property versus a room in a home, you need to check this box. This room is in my home without its own kitchen and bathroom. Now, This is the most common situation. There's another situation here where the room is more like a mini apartment or like a mother-daughter configuration. We're not going to consider that here today. We're going to consider a room, which may have its own bathroom, perhaps, but it's not anywhere near close to looking like an apartment. So we'll start with that. Now, one thing we're going to walk through is how to specify expenses that are attributable to only the rental and expenses that are attributable to the overall property. And then when you get into the details, those expenses have to be apportioned appropriately. And there's one major decision you need to make in terms of how you want to apportion those expenses, which we'll get into next. First off, did you have any personal use? It's highly probable you did, so we'll say yes. Now, in terms of your days, the first box you want to say 365 because we assume that you owned it throughout the year, so you would say 365 there. Now you want to make sure that these next three boxes all add up to 365. So in this example, we used the room personally 100 days, the room was rented 100 days, and the room was offered for rent, but nobody took it, and I didn't use it personally. So that would be 165. So as you can see, that's just example numbers here. Put in the numbers that are appropriate in your situation. Now here's where we get into expense proportioning. Now there are two different methods to apportion expenses that are attributed to the property to your room rental. And each of these has a different calculation. Now, to really cut to the chase here, generally speaking, the IRS method will attribute a higher percentage of your property expenses to the rental, whereas the tax court method will attribute a higher percentage of the property expenses to your personal itemized deductions. And now what that means is you have to make a decision where you want most of the expenses to go. It very well could be that you want to itemize on your personal side and you want those expenses to be as high as possible. If that's the case, choose the tax court method. However, if you are not itemizing at all and you have no chance to itemize, you're just taking the standard deduction, you're better off taking the IRS method, because that IRS method will attribute a higher percentage to your rental, which will go against your income on the rental side of your tax return. So those are the two trade-offs. So it is likely that you'll want to select the IRS method under most situations. Next, we enter income. Now, income comes from two places, generally speaking. Income that's provided in 1099s from a third party, and income from everywhere else. So here, we've just entered some income from someone who sent us a 1099. Enter the name, the address, and the federal ID number, as well as the total rent collected. You say yes, and you would do this for each 1099 that you received. Next, you would report all rent that you received that was not on the 1099. This could be someone wrote you a personal check. It could be Airbnb. It could be a rental you got from a marketplace referral site. So you would enter that here in this box. Here's our total rent. In the next screen, you need to depreciate property that's associated with your rental activity. Now, the first property that you need to depreciate is the home itself. And Just a short summary of what depreciation is. Depreciation is a non-cash charge that is claimed as an expense on your return. It accounts for the decrease in value of real property that's used in your rental activity. Now, in this case, your real property is your the structure that makes up your home, and the key thing here is it's the structure and not land. So land cannot be depreciated, only physical structures can be depreciated. So let's get started. We'll do the one let's discuss the one that I've already entered here. So you enter a description about the property. We're calling it main property, date, place, and service. Now, because this is actual real estate, we're going to select residential real estate. And we're going to calculate what's called rental use. Now, rental use is the percentage of the property that you need to depreciate that's applicable for the rental part of the property. Now, because you're only using a portion of the property for rental use, you do not get the ability to depreciate 100% of the property since you're only using a portion of it. But there are two components to rental use, and you need to calculate each one separately and then combine them. The first component is what's called the ownership portion. So that's a statement of what percentage in square footage is the rental space versus the entire property. Now, in the example we're going to use here, we're going to specify 20%. So we're going to say that the rental room is 20% of the total property. Now, the second number you need to enter is what's called rental use, and that's a percentage of the days that you use the property for renting versus personal use. Now, we had previously entered two numbers for that. We said that we rented it for 100 days, and then we had 100 days of personal use. The total of that is 200. The rental is 100, so 100 divided by 200 is 50%. So when you take that rental use of 50%, multiply it by the ownership percentage of 20%, when you multiply those two together, you get a number of 10%. So that's a quick summary of how you calculate that amount. So we're going to enter 10% here. Next, we need to know the property tax total basis and also the basis for the land. Now, keep in mind, basis is not just the purchase price of the property. It includes closing costs such as attorney fees and title insurance, and among other things. And if you use the spreadsheet that's accompanied with this video and also an associated article, it provides all the details, and you can it provides boxes where you can specify all those expenses, so you make sure you get your property basis total calculated correctly. Now, in terms of determining land, a good general rule of thumb is land is generally 20 or 25% of the total property basis. Now, it could be different in your jurisdiction based on the property in your area. If you have any question about that, please seek out a CPA who might be able to help you with that exact number if you have any doubt about it. So next, we're going to say that we acquired it after 2017. And here we go. Here's our depreciation summary. $1,394 for the first year. So that's our total expense. Now, it is quite possible you have other property that you may be depreciating. Maybe you spent a whole bunch of money on furniture or things like that. We won't get into that in this introductory video, but that just gives you an idea. This is where, if you did need to depreciate furniture, this is where you would add that expense. Now let's work on any vehicle use for your rental. Now, it is quite possible that you use the vehicle in the servicing of your rental. Now, the most common situation is you're using your personal car. So you have your own personal car, and you're going to use that car part of the time for the activities to service your rental business. Now, keep in mind that because you're renting a room that's attached to your home, there's really probably not going to be a lot of activity here. So track your mileage, and you'll probably come up with something in maybe the 5% range. So it's always good to track your mileage with evidence of your travel, so that you can back up your claim. So in the first screen, we just enter basic information about the car, how many months we used it, and the date it was put into service. Do you own or lease? We'll say you own. Now, most of these probably don't apply to you. It's possible this one does. If you did start using it in the first year, you might want to check that. Now, here are the key numbers you need to enter here. The most important number here is the mileage driven for business. This is the number of miles that you calculated based on the activity where you drove the car or the truck or whatever it is that you have. Now, since we're talking about a room rental, this would include things like you travel to the hardware store to buy supplies or things like that. And then you'd also enter total miles driven for the car for the year, as well as what's called commuting miles, which are really not relevant for the calculation, but it's here just to fill out the form. Now, because you're using your personal car for a very small amount of mileage, we suggest you keep it really simple and just claim the standard deduction. You'll get a nice deduction just using the standard deduction of 58 cents per mile, which more than adequately covers the actual expense that you have for the vehicle. So we'll say standard mileage. Now, in these boxes here, these may apply to you: interest on car loans, personal property taxes. However, these two boxes will not modify the standard mileage deduction. This is more in terms of if you wanted to claim, perhaps you wanted to claim some of your property tax on your car, if you have it, on your personal side. And then you would need to divide that up based the rental use versus the personal use. So we're assuming you don't have that here. However, these last two boxes are important: garage rent and tolls. These expenses are not captured in the standard mileage deduction. So if you have these expenses, be sure to enter them here because they will give you a higher deduction. I've checked the boxes here that are most relevant. Vehicle available for personal use, we're assuming yes. And you have written evidence supporting your deduction. Okay, let's move on to the next topic. Now, there's another decision point here as far as how you want to enter your expenses for your rental activity. Now, you can either enter the expenses for the entire property and then take a portion for the rental, or you can enter the expenses just for the rental. Now, we suggest that you take the first option for two reasons. First, it is very likely that the expenses that you have are at the property level. They're readily available at that level, and there's no calculation required. So just for ease of entry, it makes sense to do that. And the second reason, which is more important, is that you can actually claim a deduction on the rental side for expenses that were attributed to the property that have nothing to do with the rental. So I'll give you an example. Let's say you replace the front door of your home. Now, the front door of your home is not a part of your room that you're renting. It's a part of the property. But because you can claim a portion of that repair on the rental side, you will generally get a higher deduction because you can take a portion of all the repairs and expenses that were taken for the entire property. So that's why we recommend that you're going to want to take this option. Now, as we need to know what the percentage of the home is used for the rental activity. We discussed this previously in the depreciation section, where we came up with a number of 20%. So we're going to go with that number here as well. Now, here's where you enter your expenses. Now, before we get into this, I would point out that there is an accompanying article and spreadsheet that go along with this video that gives you the ability to tabulate all of these expenses in the appropriate buckets, some pre-summarized for you before you even get to the screen. So we highly recommend that you use that. It'll make your entry much easier if you have these numbers already determined ahead of time. Now, once you have those numbers calculated and in your spreadsheet, there are two main categories here: expenses that apply to the property and expenses that apply to the rental. Now, expenses that apply to the property will be prorated based on the ownership portion as well as the rental use. So in this case, say the real estate tax is $1,000, only a portion of that will be applied to the rental. Now, when you specify your rental only expenses, these generally will be 100% deductible. You'll get the full deduction for them because they are attributed to the rental activity only. The only exception to that is this is the cleaning and maintenance, where this is prorated based upon your rental use. So if you had personal use of the room, the thinking is that you're probably going to clean it, so you don't get a deduction for the amount of cleaning that you would use for your personal use. Otherwise, all of these are deductible at 100%. Now, the next section is mortgage interest and points. I would just point out, important thing to point out here is if you do have a mortgage, your mortgage company will send you the interest on what's called a Form 1098. You want to make sure the amount in this box matches what is on the form, because that form will be sent to the IRS as well. And also, if this is the first year that you bought the property, you want to make sure you capture any other mortgage interest that was in your closing documents, because this number will not be in the Form 1098 because the mortgage company doesn't know about it because it was handled at closing. Now here, do you have both a rental and a home office? That's not common, so we're going to say no. Did you obtain a mortgage just to buy the property and not use the money for any other purpose? That's typically true, so we're going to say yes. And here's a quick summarized breakdown of the proportion of the mortgage interest and real estate taxes that are attributed to the rental versus your personal portion. Now there are two other last expense entries. There's one for just rental activity, and there's one for the property. If you have any other kind of expenses that are associated just with the rental activity, you want to specify them here. Here I've put in a number for use and sales tax that were paid on rentals. This might apply in your situation, so we just entered that here. And the next one is anything associated with the total property. Here we've assigned a value for garbage contractor as well as association fees. Now, given that these are at the property level, these will also be prorated based on your the rental percentage, the rental use. So here you are. Here's your summary of all your expenses. This is the amount for the total property. Now the ownership portion is going to be prorated based upon the ownership percentage. However, expenses that are attributed to the rental only, those are 100% all the way across. And also, many of these expenses, such as the ones attributed to the property, are also prorated based upon the rental use. So you wouldn't get 100% of the ownership portion because you had some personal use. So that, again, that these will be prorated even lower. So I'll give an example here. Mortgage interest is $1,500. When after all said and done, you're only going to get 10% for the rental portion after those two deductions are made. Now, rental losses are a topic, an advanced topic in and of its own right. We won't go into that in this video. Now, for this walkthrough, we actually have a profit. So we do want to say, were you completely at risk? And what this means is that do you own the property and did you buy it with your own money with the intent of making money? We assume that that's true here, so we say yes. Now, after it's all said and done, you can see here we have a profit of $182. So let's take a quick look at the forms as far as what actually happened. So here we are here. We're going to go all the way down to the expenses. So here's our total income all the way across. You can see that everything kind of came across. We were able to deduct everything. Of course, limited by the rental portion that was calculated previously, that we talked about previously. So you can see it's all pretty straightforward. All of it went through. And here we are here, that we have a small income, a small profit. So that will show a profit on your tax return. So there you go. There's your first tax return for a room rental for your vacation property. If you have any questions about this, or if there's some specific need or special situation that applies to you that we didn't cover in this video, keep in mind this is an introductory video. It's not going to cover all situations. Please leave a comment in the video below or in the article below, and or you can also reach out to us by contacting us on our About Us page at vacationlord.com. Thanks for watching.